Hello everyone, I'm Edwin. Happy to see you here again. So when you're reading the news, you may find that Hong Kong economy is beginning to recover, but the unemployment rate is still at a high level and there are still many shops closed. So in this circumstance, how could the property market still on a rising trend? From the figure, you can see that the property prices have been rising slowly for almost a year since last May. The momentum has increased in this year. So compared with the rising unemployment rate, it seems that there is a divergence. But this divergence is not unique in Hong Kong. Property price in many cities, such as Seoul, London, and New York, has also been increased for more than 10% in the past year. This pattern seems ridiculous from the conventional wisdom point of view. So, does the current property price really overpriced? To answer this question, we have to clarify the relationship among several concepts. They are price, money supply, indicators, and real value. So for example, a tree can produce 5 apples per year. And the value of each apple is $2, then the annual income of the apple tree will be $10. Now suppose that based on risk nature of the apple tree, investor require 20% annual return. Then we can find that the value of apple tree should be $50. So when the output of apples decrease from 5 to 4, the total income of the apple trees will drop to $8. Based on the required return of 20%, the apple tree should now worth $40. So this example explains why people expect asset prices should fall during bad time, but we have seen that the property market and the stock market have risen instead of falling in the past year. The price in some markets even achieved its historical highest. So there should be a problem in the previous deduction. Where does it go wrong? The mistake here is that we assume money supply remain unchanged in the previous example, but it is not the case in the real world. Now suppose in our hypothetical world, there is only one asset in our economy, which is apple tree. If the number of apple tree is 2, then we can infer that people are willing to allocate $100 in risky asset. So let's say if the government double the money supply when the production of apple drops, what will happen to the price of apple tree? When money supply is doubled, the money that can be allocated to risky assets would increase from hundreds to 200s. As the number of apple tree is still $2, the value of apple tree will rise to $100 instead. And this exactly explains why asset prices keep increasing all over the world in the last years, as many governments adopt expansionary monetary policies. The consequence on the rate of return is that it will drop from 20% to 8%. But you can see that even in this situation, there is no bubble. Asset price is still equal to its fair value. It's just because the money supply increased. And we know that asset price is correlated not only with the fundamental value, but also with the money supply. So the increase in money asset price just reflects the increase in money supply. So the lesson here is that successful investment not only require your knowledge on the asset itself, but also on your analysis on the future changes in money supply. So based on our investment experience in last year, the latter could play a very important role in investment analysis. So in investing, many investors like to use different indicators for references such as rental yield and house price to income ratio. Unfortunately, many times using these indicators is harmful rather than beneficial to your investment in the generation that we have faced increasing and increasing money supply. And you can see that the rental yield before 2014 never fall below 4%. So if investors believe that 4% is in benchmark to indicate overpriced property, they will sell their holding in 2014 and wait for the fall in the property price. Unfortunately, it could be a serious investment mistake. You can see that the return is very high, and then if the property hold up until now, the investor can actually sell it at 50% higher price. So now we also heard that some people said that the rental yield of less than 3% is too low and the current property price cannot be sustainable. Again, based on our prediction on an increasing money supply, I can say that the rental yield is more likely to go to 2%, then back to 3%. Another property market indicator that people like to use is the house price to income ratio. You can see that this ratio has been rising in the past 20 years. Based on conventional wisdom, it should be already too high. But again, in the past 20 years, the property price increasing with this ratio. So these two examples suggest that indicator could be misleading when the money supply is not fixed. The same logic also applies to stock market indicators, and we can see that the average PE ratio of S&P 500 is around 20 times. So if some investor found that the PE ratio was so high, about 20 times in 2014, they would then plan to sell it at that time and plan to buy back the stock when the PE falls back to 15 times. Unfortunately, again, this trading strategy is a disaster, as it will make investors forego almost 100% returns in the coming few years. So again, we should be cautious when you want to use those indicators in trading. One of the greatest economists, Milton Friedman, has a famous quote: "Inflation is always and everywhere a monetary phenomenon." So would we be surprised about the price of hamburgers keep increasing for the past few decades? Not really, right? It just makes sense. So if I ask what will happen to the price of hamburgers in the next 10 years, I guess people would probably think that the price will keep increasing. But why we take different view on these two assets or product? I guess we should treat them the same, because when the supply increase, it will need to increase in both hamburger price and the stock price and property price. The difference only between the volatilities in the stock and volatility in the hamburger. But on the long term, we should expect that they are rising. So recently, whenever the stock market fall, some people would like to interpret it as the market worries that the government will tighten the money supply in the futures, so the interest rate will rise and the asset price will fall. So definitely it's possible, but is this probability that high? First, from the figure we can see that money supply M2 has been increased for more than 20 times, and no evidence to support the view that this trend will be reversed in the future times. Second, after the quantitative easing in 2008 financial crisis, even the economy recovered after 2 to 3 years, the abnormal low interest rate also keep for more than 8 years. The current pandemic hit the economy much stronger than 2008 financial crisis. So I don't really think that the chance of a rise in interest rate is high in the coming 3 to 4 years. Moreover, the government will only raise the interest rate when the recovery of the economy is confirmed. At that time, corporates should have enjoyed a higher profit, so it should be favorable to the stock price. So it just explains why the S&P 500 has risen for more than 12 years in the past. Because in a good day, profit is higher, so stock price higher. In a bad day, even though the profits goes down, but because the government will increase the money supply, so the stock price will eventually rise again. Therefore, it's very important, with the continuous increase in the money supply, the new long bubble is inevitable. But be careful, we just said that the general asset price will increase, but the downside risk of a single asset or a particular class will still be quite high. For example, in the past years, although the stock market and the property market rose, the price of gold fell. So today, the key takeaway is that in the time that money supply keep increasing, apart from setting aside some cash for precautionary purpose, we better not to allocate our financial resources in bank account or bond because the yield is so low and we cannot even keep up with our purchasing power. So therefore, the question what you should ask is not whether you should invest now or later. It's what to invest and how to create a good portfolio. So what and how should we invest? So let's keep it for our next video. And so here I'll thank you for watching, and I hope that today's sharing will make you consider again how to invest under the new normal bubble, and then how to make a better portfolio for you to achieve your financial goals or life goals. So thank you again, and I'm Edwin. See you next time. Bye.